Picture this. You walk into a store looking for a new smartphone. There are dozens of options, different brands, prices, and features. You think, which one should I buy? Now imagine you're the CEO of one of those smartphone companies. You're asking, how do I price my product? What features will customers value the most? How do I beat the competition? These questions aren't just random musings. They're the essence of managerial economics, the strategic science that helps businesses thrive. Welcome to today's video. We're diving into what managerial economics is, exploring its key principles, and showcasing real-world examples to bring it all to life. First, what is managerial economics? Managerial economics is the application of economic principles and methodologies to solve business problems and make strategic decisions. Think of it as the toolkit that helps managers balance costs, maximize profits, and navigate market complexities. In simpler terms, it's about making informed decisions. Whether it's setting prices, forecasting demand, or allocating resources, managerial economics equips businesses with the insights they need to succeed. Managers often face questions like, how much should we produce? Should we expand to a new market? What price will maximize our profit? Managerial economics provides the framework to address these questions systematically. It bridges the gap between abstract economic theories and the practical challenges of running a business. Second, key concepts of managerial economics. Let's break down some foundational concepts that define managerial economics. 1. Demand analysis. This focuses on understanding consumer preferences and forecasting demand for products or services. Tools like elasticity of demand and market segmentation are used to predict sales and set prices. For example, Netflix uses demand analysis to decide what shows or movies to invest in. By studying user preferences and viewing history, they tailor their content strategy to maximize viewer engagement. 2. Cost analysis. Businesses need to understand their cost structure to optimize production. This involves distinguishing between fixed, variable, and marginal costs. For example, Tesla's decision to build a gigafactory was based on cost analysis. By producing batteries in-house, they reduced costs per unit and gained a competitive edge. 3. Pricing strategies. Pricing isn't just about covering costs, it's a strategic tool. Managerial economics helps determine the optimal price point that balances profitability with customer satisfaction. For example, Apple's premium pricing strategy reflects the value customers associate with its brand. Despite higher prices, Apple products maintain strong demand due to perceived quality and innovation. 4. Profit management. Profit is the lifeblood of any business. Managerial economics aids in analyzing revenue streams, minimizing costs, and identifying the most profitable opportunities. For example, Amazon's focus on economies of scale allows them to offer competitive prices while maintaining profitability, even in low-margin product categories. 5. Risk and uncertainty. Every business decision carries an element of risk. Managerial economics uses tools like decision trees and probability analysis to navigate uncertainties. For example, airlines use risk analysis to adjust ticket prices based on factors like fuel costs, weather conditions, and geopolitical events. Third, scope of managerial economics. Managerial economics extends across multiple business areas, like production planning, and determining the optimal mix of resources to maximize output. Marketing strategy, crafting campaigns based on consumer behavior and market trends. Financial management, allocating resources efficiently and ensuring liquidity. Human resource planning, deciding wages, incentives, and workforce allocation. Investment decisions, evaluating capital expenditures and growth opportunities. 3.1. Why is managerial economics important? Here are some reasons why this discipline is indispensable. First, informed decision-making. Managers can use economic models to forecast outcomes and make data-driven decisions. Second, resource optimization. It ensures that limited resources are allocated where they provide the most value. Third, strategic planning. Long-term success requires a sound understanding of market dynamics and economic trends. Fourth, adaptability. Businesses face constant changes. Managerial economics equips managers to adapt and thrive in fluctuating environments. 3.2. Tools used in managerial economics. Managerial economics relies on a variety of tools, including mathematical models. These help quantify relationships between variables, such as cost, revenue, and profit. Statistical methods. Techniques like regression analysis, forecast demand, and analyze market trends. Game theory. This aids in understanding competitive dynamics and strategic decision-making. Linear programming, a tool for optimizing resource allocation in complex scenarios. If you're watching and finding these managerial economics helpful so far, make sure to like the video, share it with others who might benefit, and subscribe for more content on business and economics. So, fourth, economic principles in managerial economics. Managerial economics relies on core economic principles to guide decision-making. Let's unpack the core principles that guide managerial decisions. First, marginal analysis. This principle helps determine the additional benefits and costs of a decision. The goal is to maximize profit by evaluating incremental changes. For example, a bakery wonders if it should bake 10 more cakes. Marginal analysis calculates whether the additional revenue from selling the cakes outweighs the cost of making them. Second, opportunity cost. Every choice comes with a trade-off. Opportunity cost measures the value of the next best alternative foregone. For example, should a tech company invest in developing new software or expanding its current product line? Opportunity cost analysis helps weigh these options. Third, the incremental principle. Decisions should focus on the incremental changes in costs and revenues rather than totals. Incremental analysis evaluates whether a particular decision adds value. For example, a retail chain decides whether to open one more store in a high-traffic area. The incremental principle assesses whether the additional revenue justifies the added costs. Fourth, the principle of time perspective. Every decision has short-term and long-term implications. This principle emphasizes balancing immediate gains with future benefits. For example, a company deciding between launching a half-finished product now to beat competitors or delaying the launch for a more polished version evaluates both time perspectives. Fifth, the discounting principle. This principle recognizes that money today is worth more than the same amount in the future. Managers use this to compare present investments with future returns. For example, a business calculating the present value of profits from a new factory 5 years down the line applies the discounting principle. Sixth, equilibrium. Markets tend to reach a balance where supply equals demand. Understanding equilibrium helps managers predict market trends and set prices. Seventh, time value of money. This is about understanding that money earns interest or generates returns over time, making it a critical factor in investment decisions. For example, when planning a 10-year project, companies calculate whether the future benefits outweigh the costs incurred today. Here's a visually engaging infographic to represent the principles of managerial economics, where each principle forms a node in a circular layout, with arrows connecting them to demonstrate their interdependence. It highlights concepts of marginal analysis links directly to the incremental principle, as both focus on optimizing changes, while the discounting principle ties to the time value of money, emphasizing future valuation. Fifth, nature of managerial economics. Managerial economics is defined by its practical, decision-oriented approach. Here's what makes it unique. Microeconomic focus. It primarily deals with individual firms, consumers, and markets rather than the entire economy. Normative and positive analysis. It blends positive analysis, what is happening, with normative analysis, what should happen, to recommend actionable steps. Interdisciplinary approach. It draws from economics, mathematics, statistics, and business management to provide comprehensive solutions. Decision-oriented. The primary goal is to aid managers in making informed and effective decisions. Dynamic in nature. Since businesses operate in ever-changing environments, managerial economics adapts to new challenges and opportunities. Sixth, managerial economics in action. Real-world examples. Example 1. Starbucks and demand. Forecasting. Starbucks excels at predicting demand for its beverages. They use economic analysis to identify peak hours, seasonality, and customer preferences. This enables them to optimize inventory and staffing, ensuring a seamless customer experience. Example 2. Uber's dynamic pricing. Uber's surge pricing is a classic application of managerial economics. When demand exceeds supply, prices increase to balance the market. This not only incentivizes more drivers to hit the road, but also ensures that riders who need urgent service get priority. Example 3. Walmart and cost leadership. Walmart leverages cost analysis to maintain its position as a low-cost retailer. By optimizing supply chain logistics and negotiating bulk discounts, they offer competitive prices while maintaining profitability. Seventh, challenges in managerial economics. Despite its benefits, managerial economics isn't without challenges. Data limitations. Accurate decision-making requires reliable data, which isn't always available. Dynamic markets. Rapid changes in technology and consumer preferences can render analyses obsolete. Complexity of models. Economic models often involve assumptions that may not hold in real-world scenarios. Globalization. Operating in a global market adds layers of complexity due to differing regulations, cultures, and economic conditions. And there you have it. A managerial economics isn't just for big corporations. It's a vital tool for any decision maker aiming to maximize value. From pricing strategies to risk management, it empowers businesses to navigate complexities with confidence. So the next time you face a tough business decision, remember, with the right tools and frameworks, you're already halfway to the solution. They're your secret weapon for success. And if you're looking for a deeper dive, I've linked a recommended book on this topic in the description below. Be sure to check it out. Thanks for sticking around. If you're watching this, I have a great video on marketing management that you'll find useful. Click here to watch it next.